Hey, thanks for taking time to look at our royalty calculator. Getting money using royalties is a great way to go for a small business, and what I'm going to do in this spreadsheet is show you how we calculate what a good royalty payment might be depending upon the amount of money that you want or the return on investment that you think investors are wanting to get from a deal with you. This is our spreadsheet, and we've got two worksheets in here. We've got to compute the amount spreadsheet, and we've got to enter the fund amount spreadsheet. And these are different things depending upon what you want to do. For instance, if I know the amount of money that I want, then I'll use the enter the fund amount. If I'm not sure how much money I can get based upon what I'm selling, how many I'm selling, and so on, a good way to go is to compute that fund amount. We're going to do that second. We're going to start out here with the enter the fund amount, and I'm going to go over the basics content of this spreadsheet first. We've got, first of all, we've got the fund amount that we want, how many years we're going to pay royalties, what our unit cost is, and that can be wholesale, retail, what the selling price is, again, wholesale, retail, and then we calculate the margin, the difference between the two. Then we set up a percentage of that margin to be paid as a royalty. So in this case, we're using 30%. The cost of a share in the investment club is $100, regardless of the number of shares sold. And in this case, we're paying $2.40 per unit as the royalty based upon that 30%. So anything in gray is calculated, anything in green you can input, and the numbers in red indicate that they change the ROI to the investor. Next thing I want to talk about is the quantities of units that you're going to sell. We want you to first put in last year's sales for this unit if you have them. If you don't have them, you can set this column to the first year sales projections and just move these over. These are all editable up here. But you always want to start in this column first. So for instance, if you had 0 sales last year, this would be first year sales, fifth year sales, maximum production sales. So if you can only produce X number of them, that would be the maximum that you could do. At the bottom here, we're computing out that one share at $100 over the term of this agreement is going to pay $229.68 based upon the quantity that you sold last year, with a slight increase of 1% per year for 10 years. Now you can see that at year 6, that's the last year that we paid royalties because that was the term of the agreement. All right. Then down here at the bottom, we can say these are values that we're computing for the ROI. And you can see that it's a good value. It's above 20%. And then if you do better sales, 50% better than what you did last year, this would be the ROI, and if you did even better than that, that's the ROI. These are the upsides to your investors. All right, so let's just see how this actually works now. We feel like we're being a little bit too lenient on the royalty, so let's drop this down to 20%. All right, we're not going to change any of the quantities because that's what we thought we could do. And you can see now that for a $100 investment, we're only paying $153, and they have to take their $100 out of that, right? So their return on investment is basically 8.85%. Now that'd be great for a bank or a CD, but for a risky investment such as these, it would not be a good risk or return on that investment. You can see that once you get up into the higher quantities, the value of that investment goes up. So what we need to do is find a middle ground here. So instead of 20%, let's make it 25. And let's take another look. Well, it says if we do what we did last year, I'm going to pay 15% to the investors. But if we do what I think we're going to do, I'm going to pay 23. So that's a pretty good upside. That's a reasonable risk for someone to take. And then you've got to basically convince them that this money is going to help you generate 50% more sales. All right, so that's it for let's go to our compute fund amount. Now, this kind of changes around because basically we're going to compute how big the fund could be based upon the input we're giving. And again, we've got the term of the agreement, we've got the unit cost, the selling price, the margin, how much of that margin we're going to pay in royalties. You'll notice here I've got yellow on this spreadsheet, and that basically says only value that I change on this entire spreadsheet that's going to change the ROI is the term. Everything else is just going to change how much money I get. If I do these numbers right here, the net to the business is $52,000, which is after fees. Now let's look and see what's happened to the royalty. It looks fine. So what we're saying is this is the point in time in which the investor gets a full return on their initial investment. So you can see here, we've loaned out, we've received $54,000 or $55,000 from the investors. And year one, we're paying out $27,000, year two, $27,000. So at the end of year two, the investors have only gotten their money back. They haven't made any additional profit. Well, once they go for another year, then they're going to pick up some money, and that's where this number comes in. Gosh, that seems like $27,000 in interest. Sounds like a lot. I'm paying it. Maybe I could cut that back to 3. So let's try 3 years. So now you'll notice we're not really adjusting the amount of the loan. We're adjusting the ROI. Well, going from 4 to 3 years, we dropped down below that 20% based upon last year's sales, and even the sales for the subsequent year of $15,000 is really not enough to pick it up because we're cutting it off so close to the point where they just got their money back and we're only giving them 1 year. What we can do is, again, we go back to 4. So what we're saying is we're going to give them 4 years of payments back, but we always have the option of an early buyout payment. So you can borrow the money and 30 days later you can pay back this amount of money to terminate your royalty agreement. So we've got 35% for 4 years, which will pay 23% if you don't do any better than last year. But remember, there's always a chance you won't even do as good as last year. And that's where the risk comes in for the investors. You've got an ROI out here for the additional years and so on. Now, if you don't think sales are going to be this flat, you can come in and you can change these values. Thanks for your time. I hope you are able to use the royalty calculator. We'll send it to you as soon as you apply. Good luck.